In today's video, we're diving into 4 retirement expenses that most people never see coming, but they have a sizable impact on your long-term financial security. These aren't extravagant luxuries or bad money habits. They show up through generosity, family obligations, and healthcare gaps, and lifestyle choices that felt reasonable at the time until they weren't. And the worst part, most of these expenses hit after you've already stopped working, when flexibility is limited and every dollar matters more. I'm Rosanna Quinnen, a chartered financial analyst and founder of QueenVest, where we help successful professionals and business owners plan and enjoy a happy, long, and financially secure retirement. I work with hundreds of retirees over the years, and I've seen these expenses quietly derail even the most well-thought-out plans, not because people were careless, but because they simply didn't know what to watch for. That's why today I'll walk you through each of these hidden costs and show you how to spot them early, plan around them, and protect your retirement before they chip away at your freedom. And we'll start with one of the most quietly draining, not financially at first, but emotionally and over time: helping adult children more than you had planned to. A recent Savings.com study found that 50% of parents with adult kids now provide regular financial support, averaging about $1,474 per month per child. It usually starts small: rent, groceries, phone bills, and feels like the right thing to do after they finish college. But what's meant to be short-term often stretches into years. 61% of parents say they're already scaled back their own finances to help, and 27% say it's delayed their retirement altogether. My client Kathy is a good example. She's a single mom of 2 girls, and even as Kathy is still saving for her own retirement, she's committed to paying for one of her daughter's graduate school. It feels like the right thing to do as a mother. But Kathy's missing out on tens of thousands of dollars in retirement savings that would add up with compounding over the years. The problem isn't helping, it's knowing how much is too much or how long is too long. And without clear boundaries, your retirement goals can push back. But adult children aren't the only loved ones who create unexpected financial strain, especially when care, not cash, becomes the bigger cost. Many retirees face a second layer of unexpected support for their aging parents. After my client Nancy's father passed away, she has started flying to California twice a year, even as her sister Annie lives close by. Nancy feels the obligation to contribute both her time and financially to care for their aging mother. Whether it's helping with medical bills, flying cross-country for caregiving, or simply being the reliable one in the family, the costs add up quickly, both emotionally and financially. On average, family caregivers in the U.S. spend $5,531 per year out of pocket supporting older parents. And when you cut between supporting children and parents at the same time, the financial strain compounds fast. But the next expense doesn't come from generosity or obligation. It comes from a dream that slowly turns into a drain. A second home often starts as a dream, a getaway, a place for a family, maybe even a future legacy. But over time, the reality sets in: rising insurance premiums, property taxes, maintenance, and a house that often sits empty. And in states like Florida, homeowners insurance has jumped by 80 to 100% in just 3 years. My clients Jim and Sally bought a place in Florida only to see it ravaged by a hurricane. And now, rather than spending leisurely days on the beach, they're dealing with contractors who don't show up and budget overruns they never planned for. And while some costs build gradually, others hit like a lightning bolt, often when you're least prepared to pay for them. The most financially devastating expense often arrives without warning, and it's a health shock Medicare doesn't fully cover. Most people assume they'll deal with it when the time comes, but a single diagnosis, fall, or emergency surgery can quickly drain savings, spike taxes, and permanently alter your lifestyle. According to Fidelity, the average 65-year-old couple retiring today will need over $320,000 out of pocket on healthcare in retirement. And that does not include long-term care, dental, vision, or hearing. My client Tom was diagnosed with Parkinson's disease in his mid-50s and had to cut back his career, go on disability, and face big out-of-pocket expenses he and his wife Maria never accounted for in their plan. So how do you protect your plan from all of this without living in fear or cutting back on the retirement you worked so hard to build? That's where a different kind of planning comes in, one that's built for real life and not just ideal scenarios. These surprising expenses can feel overwhelming, but they don't have to catch you off guard. The truth is, a strong retirement plan isn't about predicting every bump in the road. It's about having a flexible plan that can absorb those bumps without throwing your whole life off course. I call this approach longevity retirement planning, and it's something I use with every client I work with. It's a 5-part strategy designed to help you stay in control no matter what life throws at you. So let's break it down, starting with the foundation. Get clear on what really matters. The most important move you can make isn't about saving more. It's about getting clear on what you're actually saving for. When you define what matters most to you in retirement, whether that's spending time with family, traveling freely, staying in your home, or simply having peace of mind, every financial decision becomes easier and more aligned. Without that clarity, it's easy to react to whatever feels urgent: a child who needs help, a parent who falls ill, a second home you rarely use. And before you know it, your resources are stretched thin, but not in service of what matters most to you. See, retirement isn't just about money. It's about living with purpose, and your financial plan should reflect that. The most important move you can make isn't about saving more. It's about getting clear on what you're actually saving for. When you define what matters most in retirement, whether it's family time, freedom to travel, or just peace of mind, you give your money direction. But clarity also means defining boundaries. That includes sitting down with your spouse to decide how much help you're willing and able to provide to loved ones and for how long. These conversations create emotional alignment and prevent financial surprises. Knowing your non-negotiable gives you a filter for setting priorities and protecting your future without guilt, conflict, or second guessing. Retirement isn't just about having enough. It's about using what you have to support a life that feels rich in ways that matter most. And that brings us to solution number 2. Set market-based spending guardrails. One of the smartest ways to protect your retirement income without constantly stressing over a budget is to use market-based guardrails. Instead of locking yourself into a fixed monthly number, you set flexible spending limits that adjust based on how your investments are performing. In strong market years, you might give yourself room to spend a little more, maybe travel, home upgrades, or family gifts. In weaker years, you scale back slightly to preserve your long-term financial security. And it's not about guessing. It's about defining 3 clear zones: a baseline level of spending, essential and non-negotiables, a target range for normal years, and a maximum cap for great years, and a minimum floor for down markets. These guardrails help you protect your lifestyle expenses year by year based on real performance, not blind optimism. And that makes every spending decision easier because you're not reacting emotionally, you're adjusting strategically. One of my clients, a retired couple in their early 70s, used this exact approach. When the markets had a strong year, they gave themselves permission to finally take that anniversary cruise they talked about for years. But during a down year, they pulled back slightly, delaying a home project they'd planned without stressing or second guessing. Because they had those guardrails, the decision wasn't emotional, it was automatic. And that one shift has helped them stay retired with confidence, even through unpredictable markets. Now, I know a few of these expenses and strategies might be hitting close to home, and you might be wondering, does this apply to me? And are we at risk of facing the same surprises? That's exactly why we created the Retirement Readiness Fast Track video, a complimentary personalized video where my team and I review your exact situation and walk you through what to do next to stay on track. It's free, quick, and tailored to you. But because of the time these take, we can only offer it to the first 20 people who request one. Just click on the link below, answer a few quick questions, and we'll send you your personalized roadmap within 48 hours. Now back to the video. Managing spending isn't just about protecting your present. It's also about preparing for the surprises ahead. And that starts with how you organize your savings. And the easiest and most powerful way to get organized is to earmark savings for specific goals. Remember the old envelope system? People used to manage cash by separating into physical envelopes, one for groceries, one for rent, one for emergencies. It was simple, visual, and effective. While paper envelopes may be outdated, the principle still works. It's incredibly useful in retirement. Today, you can recreate that structure digitally by designating specific bank accounts for different categories of spending. Think one for travel, one for helping kids, one for healthcare surprises, and so on. This approach turns big goals into clearly defined buckets. When a need arises, a medical bill, a wedding gift, or a leaky roof, you're not scrambling or wondering what you can afford. You've already planned for it. After we put the system in place for my client Bill, he told me, I love seeing these amounts in these accounts and know for the first time in many years, every bill doesn't feel like a scramble. And by keeping those earmarked funds separate from your core retirement income, you avoid the mental trap of thinking everything is fair game, helping you stay on track no matter what pops up. Of course, not every expense is predictable, especially when it comes to your health. And while earmarked savings can help with general surprises, healthcare is one area where having a specialized reserve can make all the difference. If you're still working and eligible, a health savings account or an HSA is one of the most powerful tools available. It allows you to save pre-tax, grow your investments tax-free, and withdraw funds tax-free for qualified medical expenses, including in retirement. If you're already retired and no longer contributing, setting aside a separate reserve for healthcare, whether inside an HSA or a regular account, gives you a buffer when you need it most. Remember, Medicare does not cover long-term care, dental, vision, or hearing, and the out-of-pocket costs can be significant and draining to your lifestyle. By having dedicated healthcare reserves, you're not just protecting your budget, you're protecting your peace of mind when life throws you a curveball. By far the most important, yes, the most challenging way to manage your expenses in retirement isn't even financial. It has to do with communication and aligning your plan with your family. Because even the best retirement plan can break down if the people it affects most don't know what it is or what role they play in it. That's why open communication isn't just a financial skill, it's a relationship skill. It is one that can dramatically improve the health of your family over time. Talking about money, caregiving, or support boundaries isn't easy. In fact, most families avoid these conversations until something forces them, like a health crisis, a job loss, or inheritance issues. But if you're willing to start the conversation early, even imperfectly, the benefits are enormous. You reduce misunderstandings, prevent resentment, and create shared clarity that strengthens trust and not tension. That might mean talking to adult children about what kind of help is or isn't part of your retirement plan, or discussing with siblings how you'll divide care for aging parents. These aren't always easy conversations, of course, but they're the foundation of a plan that works financially and relationally. And often, just opening the door a little bit is the most powerful step you can take. At the end of the day, being prepared is half the battle. You can't predict every expense or life event, but you can put the right structure in place so that surprises don't become setbacks. And that takes more than just smart investing or budgeting. It means combining both financial strategies or non-financial clarity, things like boundaries, communication, and flexible spending. So your retirement is ready for real life, not just the ideal version of it. If you want help building that kind of a plan, one that gives you confidence, not just spreadsheets, we'd love to show you how. Just click the link below to request your retirement readiness fast track video. It's completely free, customized to your situation, and designed to help you move forward with clarity and confidence. You work hard to leave your future to chance. Let's make sure you're ready for whatever comes next. Thanks for watching, and I'll see you in the next video.